What if the fate of the entire American economy once rested on the shoulders of a single man? Picture this. It's autumn 1907 in New York City. Gas lamps cast a flickering glow on Wall Street, and the clip-clop of horse-drawn carriages echoes past the grand marble columns of the city's biggest banks. But inside those banks, the air is thick with fear. Stock tickers are spitting out nothing but bad news. In smoke-filled back rooms, bankers whisper to each other, their faces pale with anxiety. On the surface, America is booming. Skyscrapers are racing toward the clouds, and fortunes are being made seemingly overnight. But just beneath this glittering facade, the entire financial system is incredibly fragile. There's no Federal Reserve yet, no FDIC insurance, no safety net whatsoever. There's only hope, rumor, and the iron will of a few incredibly powerful men. Then it happens. A single disastrous gamble sets off a chain reaction. A major trust company collapses. Suddenly, ordinary people are lining up in the cold, desperate to get their life savings out before the doors close for good. Panic spreads like wildfire from bank to bank, from city to city. And at the very center of this storm stands one man, J.P. Morgan. Silver-haired, with a steely-eyed gaze, he is, without question, the most powerful banker in America. As the nation teeters on the brink of total economic collapse, Morgan does something extraordinary. He summons the city's top financiers to his private library on Madison Avenue. For days, they are locked inside, holding midnight meetings, fueled by coffee and cigars. A single decision made in that room could either save the country or doom it entirely. What happens when the world's richest nation has no one to call in a crisis? Who do you trust when the system itself is cracking apart? This is the story of the crisis that forced America to choose between chaos and control. To understand how we got here, we need to step back into the roaring heart of the Gilded Age. The streets of New York are alive with raw ambition. Steam whistles echo from crowded factories, and the constant chatter of stock tickers fills smoky backrooms. Everywhere you look, fortunes are being made and lost at breakneck speed. America is a land of incredible booms and devastating busts. The Panic of 1893 is still a fresh scar on the nation's memory. Banks failed, railroads collapsed, and soup kitchens lined city blocks. But by the turn of the century, a wave of reckless optimism had returned. Wall Street became the new gold rush. Speculators were betting on everything imaginable. Copper mines in Montana, new railroad lines, even companies that sold ice. This era was dominated by trusts, massive corporations that swallowed up their competitors. You had Rockefeller's Standard Oil, Carnegie's Steel Empire, and of course, Morgan's own network of banks. These giants could set prices and wield power that rivaled even the President of the United States. But this entire system was built on a house of cards. With no central bank to act as a lender of last resort, the financial system was dangerously unstable. When money got tight, panic could spread in a heartbeat. Speculation ran absolutely wild. Much of it was fueled by margin loans, which meant people were betting with borrowed money. A single bad rumor could send stocks plunging. Even the timing of gold shipments crossing the Atlantic could spark a crisis. Then, in 1906, a massive earthquake devastated San Francisco. This wasn't just a local tragedy, it shook the world's insurance markets to their core. Insurance companies had to pay out enormous sums, draining cash from banks in New York and London. Liquidity, the lifeblood of the economy, dried up. Banks started getting nervous. By the autumn of 1907, the system was stretched to its absolute limit. It was just one bad bet away from complete and total disaster. This unchecked ambition and wild speculation had set the stage for a catastrophe. America's financial system was running on little more than hope and rumor. But the real panic, the one that brought the country to its knees, began with a single failed gamble and a frantic run on the banks. October 1907. A cold wind isn't just blowing through the streets of New York, it's sweeping through Wall Street itself. Imagine this. The Knickerbocker Trust, one of the city's biggest and most respected financial giants, makes a massive, risky gamble on copper stocks. It fails catastrophically. The news hits the street and spreads faster than a flame on dry tinder. Rumors turn into panic. Suddenly, a huge crowd materializes outside the Trust's magnificent marble building. These aren't investors, they're everyday people. Shopkeepers, factory workers, families, all terrified of losing their life savings. The line of desperate depositors wraps around the block, a human chain of fear. Inside, the tellers are overwhelmed, watching the piles of cash shrink with every withdrawal. The bank is bleeding out. This isn't just about one bank. Panic is a contagion. The fear jumps from the Knickerbocker to other banks and trust companies across the city. People everywhere start pulling their money out, convinced their bank will be the next to collapse. The stock market goes into a nosedive. Credit, the lifeblood of the economy, completely freezes up. Businesses can't get loans, merchants can't pay their suppliers, and factories grind to a halt. The vibrant pulse of New York City begins to weaken. The entire American financial system is on the verge of total collapse. In this moment of absolute chaos, all eyes, all hope, turned to one man, John Pierpont Morgan. His grand mansion on Madison Avenue transforms overnight into the command center for American finance. This isn't a government operation, it's a private rescue mission led by the most powerful banker of the age. By candlelight, Morgan summons the presidents of New York's biggest banks and trust companies. He famously locks them in his library, a prisoner of their own making, refusing to let anyone out until they agree on a plan to save the system. For days and nights, fueled by coffee and sheer willpower, Morgan orchestrates a series of audacious bailouts. He doesn't just ask for money, he puts his own immense personal fortune on the line, a staggering sum for the time. He pressures his fiercest rivals to do the same, using his reputation and sheer force of personality to unite them. He even strong-arms the U.S. Treasury into depositing federal funds into the most vulnerable banks to shore up their reserves. But it's a desperate fight. Every hour brings fresh rumors, new bank runs, and the constant threat of another major failure. Morgan's library becomes a fortress against the financial storm, its windows glowing late into the night as he battles to hold the line. What happens when trust, the very foundation of banking, vanishes in an instant? How did one man, with no official authority, become the de facto central bank and the last hope for a nation in freefall? Could his immense power save the system, or was he creating a dangerous precedent for the future? Finally, after a week of high-stakes negotiations and last-minute deals, the panic breaks. Morgan's iron will and masterful coordination stop the bleeding. Banks slowly begin to reopen their doors. The stock market starts its long, painful climb back. New York and America takes a breath. But the crisis leaves deep scars and raises an unsettling question. Across the country, people are outraged. How could the fate of the entire nation rest on the shoulders of a single, unelected private citizen? Newspaper cartoons depict Morgan as a colossus, sometimes a savior, other times a king, and often a shadowy puppet master pulling the strings of the economy. The crisis was a wake-up call. Congress launches investigations, most famously the Pujo Committee, which exposes the incredible concentration of power held by a small group of financiers known as the Pot of Money Trust. The conclusion is inescapable. America needs a permanent institutional safety net. It cannot rely on the whims or wealth of one man, no matter how powerful. The lesson from the ashes of 1907 is clear. The country needs a true lender of last resort, an entity that can provide stability when panic strikes. After years of intense debate and political battles, this idea takes shape. In 1913, President Woodrow Wilson signs the Federal Reserve Act into law. This creates a new central banking system for the United States, composed of 12 regional banks overseen by a central board in Washington. The Fed is specifically designed to be the firewall, the institution that can inject liquidity into the system and prevent future panics from spiraling out of control. It was a revolutionary step, born directly from the chaos of J.P. Morgan's private bailout. The age of the private savior was over. The age of the central bank had begun. But as one chapter closed, another opened, bringing with it new questions about power, control, and the enduring challenge of keeping our financial world safe. What if I told you that for one terrifying week, the entire American economy was saved by a single private citizen? This isn't a movie plot. It's the real story of the panic of 1907, a crisis that forced America to confront a dangerous truth. Its financial system was built on a house of cards. Imagine a world without a safety net. No Federal Reserve, no FDIC insurance. Your life savings could vanish overnight because of a rumor. In October 1907, that's exactly what happened. A failed gamble by a copper speculator triggered a chain reaction. Trust evaporated. Depositors, gripped by fear, rushed to pull their money out of banks. Healthy institutions were dragged down with the weak. New York City, the heart of American finance, was on the verge of collapse. The stock market plummeted nearly 50%. It was financial Armageddon. With the government powerless, Wall Street turned to one man, John Pierpont Morgan. At 70 years old, the legendary banker was the unofficial king of American finance. He summoned the nation's top bankers to his library on Madison Avenue and, in a now famous scene, literally locked them in a room. He told them no one was leaving until they coughed up the money to save the system. Morgan organized a multi-million-dollar bailout fund, personally deciding which firms would live and which would die. He was judge, jury, and executioner. His plan worked. By sheer force of will and a mountain of private capital, Morgan stopped the panic. But the rescue left a bitter taste. America had been saved, yes, but it was also a profound wake-up call. Was it acceptable for one unelected private banker to hold so much power over the nation's fate? What if Morgan hadn't been there? What if he'd made the wrong call? The consensus was clear. Never again. The reliance on a benevolent despot was too risky. This crisis directly exposed the need for a public institution, a lender of last resort that could provide stability without being beholden to private interests. 6 years later, in 1913, the Federal Reserve was born. It was designed to be the very thing America lacked in 1907, a central bank capable of managing the money supply, controlling credit, and acting as a firewall against financial contagion. The goal was to end the cycle of boom and bust, to tame the panics that had plagued the country for a century. The age of Morgan was over. The age of the Fed had begun. So, did it work? Has the Fed truly ended financial panics? Fast forward through history. 1929, 1987, 2008, 2020. The names and dates change, but crises keep coming. The nature of the panic, however, has transformed. Instead of bank runs by everyday depositors, we now see massive institutional bailouts. We hear terms like too big to fail and moral hazard. The idea that if you know you will be rescued, you're more likely to take reckless risks. The Fed steps in, slashing interest rates, printing money, and buying up assets to flood the system with liquidity. The panic is managed, contained, but the underlying instability remains. The Panic of 1907 teaches us a timeless lesson about the delicate balance between risk, trust, and control. It shows that while we can build new systems and create new rules, human nature, our ambition, our fear, our greed, remains constant. Every generation believes it has finally solved the problem of financial crises, only to be humbled by the next one. The tools have changed from gold-backed currency to digital fiat money, but the fundamental challenge endures. The story of J.P. Morgan and the birth of the Fed isn't just a historical footnote. It's a mirror reflecting our own time. It asks us a critical question. In the next crisis, who will save us? Will it be another powerful individual, a government institution, or will the system finally break? History warns us that the next panic might not look like the last, but its impact will be just as real. Knowing this past is the best way to prepare for the future. Thanks for watching. If you want to understand how the past secretly shapes your money and your world, make sure to subscribe for more deep dives into economic history.